On Friday morning, markets were pricing a 50% probability of a Federal Reserve rate hike. By Monday afternoon, that number was 2.2%. That repricing did not happen because oil prices fell. Brent crude was still trading near $113 a barrel. Gas prices hit $3.99 nationally, the highest since Russia's invasion of Ukraine in 2022. The Strait of Hormuz, through which 20% of the world's oil flows, remained effectively closed. Nothing about the supply shock had changed. What changed was a single appearance by Federal Reserve Chair Jerome Powell at Harvard University. For the past several weeks, a very specific fear had been building on Wall Street. The logic ran like this. Oil is up 50% in March alone, the steepest monthly gain since the 1990 Gulf War. Inflation was already stuck at 3%, a full percentage point above the Fed's target before any of this started. If energy prices feed into core inflation expectations, the Fed may have no choice but to hike. Barron's ran the question, Bloomberg ran it. Societe Generale put a base case Brent forecast of $125 for April in a client note, with credible spikes toward $150 if the Houthis close the Bab el-Mandeb Strait. The rate hike narrative had its own internal logic. The problem is that this reading applied the wrong framework to the wrong kind of inflation. A rate hike combats demand-driven inflation, the kind created when too much money chases too few goods because the economy is running hot. What the U.S. is experiencing right now is a supply shock. Energy prices are rising not because consumers are spending more freely, but because a physical choke point has removed 20% of global oil from circulation. These are structurally different problems. Powell made this distinction explicit at Harvard on Monday. By the time the effects of a tightening in monetary policy take effect, the oil price shock is probably long gone, and you're weighing on the economy at a time when it's not appropriate. In plain language, hiking rates now would arrive late to the inflation fight and early to the next growth problem. The Fed's own historical track record supports this. During the 1973 oil embargo and the 1979 Iranian Revolution, aggressive monetary tightening deepened recessions without meaningfully shortening the supply shock. The lesson, codified into Fed doctrine over decades, is to look through supply-driven price spikes and preserve policy space. The market had temporarily forgotten this lesson, or more precisely, the combination of a prolonged war, rising gas prices, and an election-year narrative about the Fed losing control had caused traders to briefly suspend orthodox monetary theory and price in a hike as a near-certain event. What changes when the correct framework is applied? First, the rate cut path reopens, though narrowly. Bond traders moved Monday to price in at least one cut in 2026. The 10-year Treasury yield moved off its recent highs. That shift matters for valuations across equities, particularly in technology, where long-duration earnings had been discounted by rate hike fears. The Nasdaq, which had fallen more than 2% at points during Monday's session, paired losses.
Second, the real risk calculus clarifies. Former top Trump White House economist Tyler Goodspeed, whose new book on recession causes was published Monday, put it in terms the market should absorb. Energy is historically one of the highest linkage inputs in the economy. The real threat from this oil shock is not that it triggers a rate hike. The threat is that it directly compresses household spending. The national average gas price increase from February translates to roughly $35 a month less in disposable income per driver, while simultaneously raising input costs across transportation, manufacturing, and goods delivery. NBC News reported that analysts at Moody's and S&P Global both characterized the current situation as a growth scare rather than an imminent recession, but warned that a conflict lasting more than 3 to 4 months becomes a systemic problem. Third, the Fed's posture exposes a gap. Powell confirmed rates remain at 3.5% to 3.75% and described that level as a good place. The Fed is explicitly choosing to absorb supply shock inflation rather than fight it with rate hikes. That is the correct call for the short term, but it also means the Fed is effectively standing aside while Brent crude sits above $110 and gas stations charge $3.99 a gallon. If inflation expectations become unanchored, if households and businesses begin pricing future goods based on elevated energy costs rather than treating them as temporary, the Fed's looking-through posture will need to reverse at speed. Powell acknowledged this directly. It's something we will eventually maybe face the question of what to do here. The weight of evidence points toward the no-hike thesis holding, at least for the next 60 to 90 days. Powell's framework is historically sound, and the market overpriced the hike probability by treating a supply shock as a demand shock. If Brent stabilizes below $120 and the Strait of Hormuz sees any partial reopening, even 1 or 2 vessels per day above the current trickle of under 5, inflation expectations remain anchored and the Fed stays on hold. That is the base case. But this only holds if the conflict does not widen materially. If the Pentagon confirms ground operations inside Iran, if the Houthi forces successfully close the Bab el-Mandeb Strait, or if Trump escalates to striking Carrick Island, the oil price trajectory toward $150 and beyond changes the entire calculus. At $150 Brent, the look-through doctrine becomes politically and economically untenable. The Fed would face a choice between a recession from supply shock and a recession from its own tightening. Neither path is clean. Watch Brent crude futures for May delivery. The number that breaks the current framework is $125. That is Societe Generale's April base case and the level at which the rate hike trade likely returns in force. If Powell is right that this is a supply shock the Fed cannot last, the 2.2% hike probability holds. If the war outlasts the look-through window, that number moves fast.